Well, hello, guys. Thank you for tuning in to another exciting episode of Un Poco Mas. My name is DannyDealz on behalf of executive producer Hurricane Lopez and supervising producer Stock Karen. We would like to welcome you to the program. It is Thursday, May 25th, 2023. It's about 12:30 p.m. out here in Los Angeles, about 3:30 out on the East Coast. Half an hour more of trading today. I want to talk to you, of course, about SoFi Technologies Inc. What else, folks? Ticker symbol SOFI. As you know, big SoFi bull. Um, I make no bones about it. Full disclosure, I have a large SoFi position. I have had a large SoFi position since the SPAC days, and I have doubled and tripled and quadrupled down in the fours here. So I am all in on SoFi. I am not phased by the recent drop after earnings. As I've said many times, I think it was a completely artificial short attack. But as you've come to expect, I am going to bring you the latest and greatest SoFi news and analysis every day if I possibly can. Today we are down 10 cents or a dollar eight or 1.85%. Volume is moderate at 21 million shares. One thing I'd like to point out with the short on SoFi, it's not a huge short. They dug in last check about another 700,000 or 800,000 shares today, but it's a very active short, and it is used to control the price of the stock. For instance, yesterday they returned 4 million shares approximately. The day before that, they reshorted 5 million shares. Today, even though the net is only 700,000 shares reshorted or 7,000 shares more borrowed than returned, um, there's still about 4 or 5 million shares coming across borrowed and returned. So they can fine tune the price action with only 20, 30 million shares trading a day. If they want to move the price and they're willing to short or return 4 or 5 million shares, they can control the price to the penny. And you ask yourself, well, how does that benefit the shorts? It really doesn't. I don't think this short is really designed to make money in the traditional sense on the short. What you're gonna find, guys, is right here. I mean, this is what they're doing. Like, look at these short-term calls that SoFi retail investors who don't know any better buy every single week. At the $5 mark, there's 4,000 calls, and then there's 31,000 open interest. And as long as they can hold the value to about 525, 530, these calls will be almost worthless. I mean, you might be able to make a penny or two. People go, oh, they print, I sold it for a penny. You're not going to make much because you had to pay the premium for the call in the first place. It's not like, just gets to 520, you're making a profit. And of course, the 550 calls here are going to be worthless. People bought over 10,000 calls and there's 25,000 open interest. So you can see, people are just going to continue to buy these calls week after week. And, the put volume is nothing in comparison. There's a lot of fives. Um, I think that's possibly some hedging by the shorts. But in any case, you can see what these guys are doing. They control the price of the stock to the penny. Late in the week, particularly on Friday, the volume will go up. The short will go up as necessary. They're not afraid to short, 5 or 10 million more shares if they have to make these calls worthless because this is free money in the market maker's pocket. Like, shorting the shares, they can take care of that later. They can create some massive FUD, or they can have some tool analyst make some completely preposterous downgrade who was like, if he was a buy at 8, he'll just, cut his target to 250 if fictionally, like hypothetically, if that's what, would make the shorts more money. And even if it's just nonsensical, they'll find someone to do it. And they'll, on that panic, a bunch of retail idiots will dump. They'll be able to cover their short low. So they're not worried about shorting the stock because they know there's a lot of weak, dumb retail in the stock and they can manipulate them very easily and they can cover later and they can kill these calls right now and just keep all that weekly premium. They do that every single week. And most retail investors, like some of you guys are selling covered calls, and I applaud you. That's been a great way to make some money because obviously the stock has been trading in this channel from like mid fours to eight for quite some time. So covered calls can be a really good way to go. The stock, it looks volatile, but it's actually been pretty stable. It's just they make it look volatile when they want to. But it really isn't. Retail's hung steady in the stock, as have insiders and most institutions. So guys, I know it sounds like Stock Karen and Peggy Hill had a baby, and I just come on here and complain and blabber every day, but there are plenty of people going inside the numbers and inside the trends. I just want to talk about like an honest little comparison because Upstart has been getting like an absolute ton of press lately. Like they're down 11 today, and the other day they were up like 23. I know there's a huge short on the stock. Um, and just want to compare Upstart because they had some big news that Castle was going to buy like $3 or $4 billion with their loans. Of course, the media doesn't go into the actual terms of that transaction. Like, if you think they're going to buy the loans without putting in, what they think's going to go bad and actually putting in an additional buffer, you're crazy. That doesn't mean Upstart got a great deal or anything. The media doesn't even go into those details at all. They're just like, Upstart, 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 this is amazing. And they just pump the hell out of the stock. And then, of course, with the short interest. So I think what happens there is some other market maker kind of catches the short sleeping at the wheel. And they're like, listen, these guys aren't paying attention. If we can pump the stock really quickly, we'll create a little short term short squeeze. We can get in and out and they can make money that way. So it's not just, market makers, bending over retail. Sometimes they bend each other over and it's a big party. But the point is, Upstart is a pile of crap. Like, this company is going the wrong direction. Like, um, Wedbush reiterated to underperform, of course. But I mean, look at these guys. They just beat by 20 cents to lose 50 cents a share. I mean, they were doing 900 million last year, which is like 225 a quarter. They decelerated to 160 last quarter and then 150, and they're losing 55 million. So they had a bigger loss than SoFi last quarter. And SoFi is accelerating their sales every single quarter. Upstart's selling one third of what SoFi is selling right now. They're making a larger loss than SoFi, and their top line is just shrinking. So if you move over here and you look at SoFi, what the media points as like horrible earnings and the stock should crash and all their loans are going bad. But then if you actually take a look at it quarter by quarter, they're at 350, $95 million loss, 407, $74 million loss, and then 441 with a $40 million loss. I don't think they have the Q1 numbers in there. No, but it was like they were up another, I think it was 475, and then the loss was a little bit smaller than last quarter. But the point is, like, compare and contrast. Now, I know SoFi has more debt on their books. Upstart only has about $1 billion worth of debt on their balance sheet, and SoFi is going to show $6 billion, but it's a little bit deceptive. Because SoFi is a bank, their balance sheet has expanded extremely rapidly over the last year. But I just look at these two companies, and SoFi's market cap is down under 5 billion, and Upstart's market cap is 2 billion. And Upstart has one third, as I said, one third of SoFi's sales last quarter. They're making a larger loss. They're shrinking instead of growing. Their business model, I think, is far more dangerous, far less diversified. And people are talking about SoFi's loans are going to just start going bad and everything's going to fall apart. Nobody wants to buy SoFi's loans. But those same people would have to admit that SoFi borrowers have superior credit, superior income, superior on every financial metric that says if you pay your bills to the Upstart borrower, to the Lending Club borrower. I keep hearing these SoFi bulls and FUD spreaders, and they're like, well, Lending Club's people are almost as good. They only have 30 points less on their credit score and $40,000 less on their income. As if that's just like negligible, 750 to 720 and 160 income versus 120 income. Like, not that that's a huge difference on paper, but if you look at it with like the tiers of credit, that top tier is far more likely to pay their bills back than a third tier borrower. And that's why I say, the Upstart borrower, these buy now pay later turds, these are people living in rusting, leaking trailer parks, and they're buying brand new Peloton bikes, and they're buying Teslas on credit. And these are the kind of people that are making these little $1,000 loans. These loans are going to go bad. The SoFi borrower, they're borrowing at least $5,000 up to 100,000. The term is longer, from 2 to 5 years. These are people that need their credit intact for their lifestyle. They cannot just give up on their credit score. They cannot just default on their loans. And that's why Noto, and LaPointe are very, very open about this, that SoFi's loans are marked by a third party every single month, taking in consideration all sorts of information. So let me ask you this. Why would it benefit SoFi to mark their loans over optimistically on purpose? Because those chickens are going to come home to roost, Bobby Boucher. And when they do, you're going to have a huge miss on your predictions. And SoFi always goes the other way. SoFi always sandbags their earnings so they can get a beat. So if anything, you would expect them to under promise on the performance of their loans, which is exactly what Noto would do. But they're not even doing that because they're not marking the loans themselves. And if you look at the process, I've looked into detail, they take a lot of things into account, like the rates, how they predict rates are going to change, and they use, computer modeling for this stuff. They use all the best data, and they predict what percentage of these loans are going to go bad. And if SoFi has to put some additional reserves for bad loans, then that's what they're going to have to do. But it's not going to kill the company, and their loans are not going to go bad at these 8%, 9% rates that are going to happen to a lot of other companies, because the people who borrow from SoFi are much more qualified, and they care about their credit. Okay, guys, I already told you about the short interest. I just want to go back and remind you guys, Noto just did the JP Morgan Technology, Media, and Communications Conference. That was on May 24th. If you surf on over to investors.sofi.com, events and presentations, you will see these event details, and you can click on the webcast and you can give this thing a listen. I listened to it once. I'm going to listen to it again in double speed just so I can try to absorb all the information so I can make you another exciting video tomorrow. But the actual moderator was this guy who's the fintech analyst at JP Morgan, Reginald Smith. And, so he has a hold and a $6 price target, extremely bearish, I believe. But it just kind of shows you, when this guy is one of the very sober, bearish people, what a massive, massive phony um, turd this Wedbush analyst is, who cut from 8 to 5 and then from 5 to 250, all after a pretty solid earnings report, based on arguments that were complete horseshit, to put it kindly. But Reginald Smith, who is the analyst at JP Morgan and the guy moderating this fintech conference, he actually started off the interview by saying, I'm a SoFi member. I use the app. I like the app. So he's like, I'm very, very familiar with it. So I think at least this guy, like, he sounds to me, and again, I've only had a chance to listen to the interview once, and I did skip around a little bit because I was being interrupted by work and phone calls, and life gets in the way, as they say. But this guy's pretty honest, and he gave Noto a really fair shake, and Noto really shined again. He has all the answers. SoFi is not hitting home runs. They're not trying to hit home runs. They're not swinging as hard as they can. They're controlled. Their growth is controlled. It's steady. They're building the team. They're paying the stock-based compensation, and there is dilution. And a lot of this is upsetting because we're not getting to net profit as quickly as a lot of us wanted to. But again, Noto is playing the long game. He's building an extremely strong team and foundation and portfolio of companies so that he can diversify. I mean, yes, we've relied way too much on personal loans of late, but I don't think the company had a lot of choices. In the future, when things stabilize, interest rates normalize again, we'll definitely get a lot more student loans and mortgage loans. And there's other products coming online. There's travel, there's insurance. So not only that, but you have the Galileo Technesis side, where Noto's talking about, we're talking to 12 major institutions that are going to, make what Galileo's been doing look like a joke. This is real revenue opportunities here. That's not saying they're going to land all those clients, but the conversations are underway. So it's just an interesting note that this guy, Reginald Smith, who's one of the biggest SoFi bears, he has a $6 price target. I mean, I'll just point out that with the stock sitting at $5.22, that is still a 15% upside. I know that you note that right there. That is still a 15% upside from current levels. And he's one of the biggest SoFi bears. That is the lowest rating the stock gets. There's one other analyst who KBW, who he's a 5-star analyst, got a pretty solid track record. He's at $6 in a hold. Everyone else is averaging, if you average it out, 7.65, which is 47% upside. So again, I say this guy is more than halfway crook. This guy sucks. I don't like him. But again, if Peggy Hill and Stock Karen had a baby, that would be me. Call the Whaaaambulance, because DannyDealz is throwing his daily SoFi tantrum. Wah! Because, I bought a stock, I'm down, I want to blame everybody else, I want to blame the analysts, I want to blame the shorts, I want to blame God. No, I don't. I don't blame God for my poor investment decisions. But in any case, guys, that's SoFi Technologies Inc. The ticker symbol is SOFI. Little update on the day. It is down. Let's see here. Refresh. My office internet, of course, is very sluggish and very expensive, but stock is still sitting at $5.21, down one thin dime on the day. There's a couple of interesting articles out. I'm not going to bore you with them. Motley Fool, of course, Zacks, SoFi versus Upstart. I did a little bit of that today. Haven't watched this article yet, but this guy's pretty good. I like his articles. He's a Motley Fool, or his videos. He's a Motley Fool contributor. In any case, guys, that's SoFi Technologies Inc. 22 million shares traded today. Fairly uneventful day. NASDAQ is running. All my stocks are right in the toilet. So very fitting for a Thursday, guys. I expect market makers to kill all options tomorrow, inflict maximum pain on retail D-bags who are buying these short-term call options. Guys, stop buying them. Stop buying them. Stop buying them. Stop buying short-term call options. Just buy long shares if you want to invest in the company. They can't make those go to zero on a weekly basis. They cannot rob you of your premium. Guys, thank you for watching Un Poco Mas. My name is DannyDealz. For executive producer Hurricane Lopez, for Peggy Hill, and Stock Karen, we'd like to thank you for tuning in. It's 12:51 p.m. in the afternoon. This is SoFi stock, ticker symbol SOFI. You guys have a great Thursday night, and we will talk at you tomorrow.